The stock market. It is that magical place where guys in fleece vests yell at screens, and somehow, this determines whether or not you can afford groceries this week. To the average person, it looks like a legalized casino for people who use the word synergy. But it's actually a very logical, well-structured system, built entirely on human panic. Today, we are going to learn how the stock market works. Put away your textbooks because we are using the only educational tool that matters. Terrible MS Paint metaphors. Let's start with the basics. What is a stock? Imagine a pizza. Now, imagine this pizza represents a company. Let's call it Todd's Smart Toilets. Todd wants to build a toilet that connects to Wi-Fi so it can tweet about your fiber intake. But Todd is broke. He needs money to build his toilet empire. So, Todd slices up his company into millions of tiny pieces. These are called shares. He sells these slices to the public. If you buy a slice, congratulations, you now own a microscopic percentage of Todd's Smart Toilets. You are a shareholder. Now once Todd sells these shares, the people who bought them can trade them with each other. This is the actual stock market. And the price of those shares is driven by one thing: the line. Let's say Todd's toilets become a massive hit. Everyone wants one. Suddenly, everyone wants a slice of Todd's company because the company is making money. Since there are only so many slices, the demand goes up. The people who own the slices say, "I'll only sell you my slice if you pay me double." The price goes up. The line goes up. Society is thriving. But what if the toilets start catching on fire? Panic sets in. Everyone wants to sell their slices immediately before the company goes bankrupt. Nobody wants to buy the slices, so the sellers have to drop the price lower and lower just to get rid of them. The price crashes. The line goes down. Your uncle loses his retirement fund. Now, that's standard investing, but the stock market gets weirder. Enter short selling. This is the act of betting that a company will completely fail. How do you do that? Simple. You find someone who owns a slice of Todd's failing toilet company. You say, "Hey man, can I borrow that slice for a week? I promise I'll give it back." The second they hand it to you, you immediately sell their borrowed slice on the market for $10. You now have $10 in your pocket, but you owe your friend one slice of pizza. You wait a few days. Todd's company officially bursts into flames. The price of the slice plummets to $2. You buy a slice back for $2, return it to your friend, and pocket the $8 difference. You just made money off Todd's misery. And that, fundamentally, is the stock market. Millions of people, robots, and algorithms rapidly trading digital slices of imaginary pizza, trying to guess whether human innovation or human stupidity will win the day. So, the next time you see a jagged red line on the news and the anchor looks like they're about to cry, just remember, it's all just Todd's toilets. Thanks for watching. Buy a mattress and hide your cash in it.